I want to discuss the structure of an iron condor and how it looks on an option chain. So I'm going to build the iron condor on an option chain on this whiteboard. So on the left, we always have calls on an option chain, and on the right, we always have puts. And down the middle, the horizontal down the middle line is the at the money line. And the vertical line down the middle is where the strikes are normally at. So in this case, we're putting the 100 on the call side, the 110, the 120, and the 130. And on the put side, we're putting the 100, the 90, the 80, and the 70. So this is how an option chain looks. And then if we're doing an iron condor, we're selling both sides. We're selling a put spread on the put side, and we're selling a call spread on the call side, and we're doing that simultaneously. So in this case, we're selling the 110 and we're buying the 130 on the call side. And on the put side, we're selling the 90 and we're buying the 70. So this is a 20-point wide iron condor. You have the 110 and the 130, so that's 20 points wide on the call side. You have the 90 and the 70 on the put side, so that's 20 points wide. And when you're selling an iron condor, you want the market to stay between your short strikes. So your short strike on the put side is the 90, your short strike on the call side is the 110. So you want the market to stay within this range. You don't want the market to go below your 90 strike on the put side or above your 110 strike on the call side. This is how an iron condor is structured.
So let's dive a little deeper into selling an iron condor. I will discuss how to sell an iron condor on the TastyWorks platform and on the Thinkorswim platform. However, before we do that, I want to discuss the option chain a little bit more because it's important to understand the option chain when buying and selling options. So let's get started. On the left side of the option chain, you will always see calls, and on the right side, you will always see puts. And down the middle on the TastyWorks platform is the horizontal orange line, and this is what is considered at the money. And the vertical area is where the strikes are at. And if you jump over to the Thinkorswim platform, you'll see the same kind of concept. You have calls to the left, puts to the right, and this is the at the money line area on the Thinkorswim platform, and then this is the vertical area where the strikes are at. So jumping back over to the TastyWorks platform, let's dive into the option chain just a little bit more. So once again, this orange line here on the TastyWorks platform is the horizontal line, and on the call side, below the horizontal line is considered in the money, the ITM, and above it is considered out of the money, the OTM. And then on the put side, it's the opposite of the call side. So below the at the money line is considered out of the money, once again the OTM, and above the at the money line is considered the ITM, which is in the money. And when you're looking at an option chain, it's important to look at open interest, and open interest is just how many options were bought and sold at a strike price. So in this case, on the put side, it's how many puts were bought and sold at the strike prices on the put side. And then on the call side, it's how many that were bought and sold on the call side. Then to the left of the option open interest is ask and the bid, and it's on both sides here on the TastyWorks platform. The ask and the bid is where you can buy and sell at. You can buy at the ask and you can sell at the bid. So when you're looking on the TastyWorks platform, if you want to buy, you click ask, and when you click that, it's going to be green. And if you want to sell, you click the bid, and when you click that, it's going to be red. So let me clear that, and let's jump on to what's very important as well on an option chain is delta. And we have delta set up on this TastyWorks platform on both sides. Delta represents two things. Delta represents your directional risk, and it represents your probability of success. As for directional risk, delta measures how much you will make or lose for every 1 point in an underline. So let's say we're trading the SPX here, which is the S&P 500 cash settled index. And if we're trading this and we have 100 shares of it, it means that we will make or lose $100 for every point that the SPX moves. So your directional risk is to the downside if you are long the SPX. And if you're short the SPX, your directional risk is to the upside. So delta measures how much you will make or lose for every 1 point in an underlying. Delta also represents what your probabilities are. So if you have a delta of 50, then it means that you're at the money and you have a 50-50 chance of making money. If you have a delta of 40, then you have a 40% chance of making money if you bought the 40 delta, and you have a 60% chance to make money if you sold the 40 delta. So in this case, if you bought the 28.95, the market would have to go all the way down past your strike before you win. So that's why it's only a 40% chance when you buy. When you sell, the market has to go all the way down before you lose. And that's the key difference. The market has to move a lot before you lose when you sell out of the money. The market has to move a lot before you win if you buy out of the money. If you're buying and selling at the money line, which is 50-50, they're basically equal. So let's jump back in and let's talk about the strikes a little bit more. So the strikes here are called standardized strikes, and standardized strikes just means that you can buy and sell at the strike prices that you see, and that everyone can see those strike prices regardless of where they're at in the world. They can see those strike prices and buy and sell off those strike prices. So that's what it means by being standardized. And when you buy a put, it gives you the right but not the obligation to sell the underlying at the strike price. So in this case, we're looking at the 2,900. If you buy a put at the 2,900, it gives you the right but not the obligation to sell the SPX at the 2,900 strike price. If you sell, then you have the obligation to buy at that point. So if you sell, you have the obligation to buy from the buyer if they exercise their right. On the call side, looking at the 29.45, if you buy the 29.45, then you have the right but not the obligation to purchase the SPX at the 29.45 strike point. If you sell, then you have the obligation to sell the SPX at that strike price. If you are the seller, you have the obligation to sell to the buyer at the 29.45 on the call side. So if you are a buyer, you have the right but not the obligation. If you are the seller, you have the obligation to buy or sell at the strike price, depending on what side you're on. Now, a little bit more you can understand about options in an option chain. So when you're dealing with stocks, an option equals 100 shares. And when you're dealing with futures options, it's a little different, but when you're dealing with basic regular T-margin stocks, then you have one put or one call equals 100 shares. And if you're selling, it equals 100 shares. And if you're buying, it equals 100 shares. So that is the option chain that you want to be aware of. So let's now jump into the structure of selling an iron condor on the TastyWorks platform first, and then we'll do it on the Thinkorswim platform. So in this case, we're going to sell a iron condor out of the money, and we're going to sell it at the 10 delta on the put side. So once again, if you're selling something at the 10 delta, then that means you have a 90% chance of making at least 1 cent at expiration. So we're just going to sell a 10-point wide put spread first, because when you're selling an iron condor, you're selling both sides. So we're going to sell the 26.50. We clicked on the bid, and then now we're going to buy the 26.40. We're going to click on the ask, and that is the put side of the iron condor. Now we're going to move over to the call side, and we're going to sell the 7 delta on the call side, just to show you how this looks. So we're going to sell the 31.25, which we're clicking on the bid, and we're going to buy the 31.35. So we're clicking on the ask. All right, so this is how it's set up on the TastyWorks platform. And you can see right here that our max profit when you sell is what you receive in premium, and our max loss is what we receive minus the width of the strikes. So if the width of the strikes are between your short and your long is 10 points, your max loss is $1,000, because each point equals $100 and an option equals 100 shares. So if you have a 10-point wide, it's 10 times 100, which is $1,000 is your max loss minus the premium you receive. In this case, we received $130. So the max loss is $870 on this TastyWorks platform. If we jump over to the Thinkorswim platform, we'll be able to see the same type of concept. So we're going to go down to the 10 delta on the Thinkorswim platform here, and we're going to sell the bid. And you have to, if you want to do it like TastyWorks, you have to click control and then click on the bid. And then, so that's the 26.40. So we're going to buy the 26.30 because we're doing the put side first. And then we're going to go over to the call side, and we're going to sell the 7 delta on the call side as well. All right. So we sold the 10 delta on the put side. Now we're going to sell the 7 delta on the call side, and we're going to click control and hit the bid at the 31.15, and then we're going to hit control again and click the bid at 31.25. So this is a 10-point wide iron condor on both sides, and we're going to receive 130 on the Thinkorswim platform. And this is how it looks. And once again, your max loss is 1,000 minus your premium you received, and you cannot lose on both sides. So the max loss is 1,000, and the buying power that's going to be required to put on this position with regulatory margin is going to be $1,000 minus your premium, so about $830 in this case. All right, so let's jump back over to the TastyWorks platform, and let's look at this iron condor from the curve view. So this is the curve view in the TastyWorks platform, and this is how that iron condor looks. So we have the call side to the right here, and this are the call spread that we had to put on for the iron condor, and this is the put spread that we had to put on for the iron condor. So in this case, you win if the market stays between your 2 short strikes, your short strike on the put side and your short strike on the call side. If it stays between there, that's how you win. It can go past a little bit based on how much premium you receive, but just for simplicity's stakes here, we're going to say if it stays between your 2 short strikes, then you win. Okay, you don't want it to go past your short strikes, because this is in the area where you start losing on the put side, and this is the area where you start losing on the call side. So when you are trying to figure out how to sell an iron condor, you want to figure out how far are you from at the money from each strike point. So how far are you from at the money on the put side from your short strike, and how far are you from at the money on your call side from the short strike. So in this case, your short strike on the put side is the 26.50. So to figure out how far you're away from on the put side, you say 26.50 minus 29.80, which is the current price of the underlying, which we're looking at the SPX here. And then that equals 278. And then you divide that by the current price of the SPX, which is 29.28. And that equals 9.5% down for the put side. And you do the same thing for the call side. The short strike on the call side is the 31.25. So you go 31.25 minus 29.28 divided by 29.28. And that's about 6.7% up, almost 7% on the upside. So you can always be further on the put side, usually percent wise from at the money, because on stocks usually the risk is to the downside, so the prices are skewed to the downside, so you can get further away. So this is the structure of an iron condor, and this is how you sell it, and that concludes our educational video.